Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market's been all week with investors focused on the COVID-19 rescue plan. Monday started out to the upside as the president recovered quickly from the virus, and he was planning to get back to the White House almost immediately. Tuesday, we saw a choppy market actually that ended with a very large decline. Early on, Fed Powell gave some warnings, and he said that if without fiscal stimulus, well, there's a pretty good chance that we would see, quote, recessionary dynamics, close quote. Well, essentially, that's a very kind of interesting way, maybe it's Greenspan-esque way to say that the economy really is in trouble. In the afternoon, with President Trump back in the White House and really flexing his muscles, he said no more negotiating with the Democrats on stimulus. Dow Jones, which was up pretty good for the day, really fell very hard. In fact, there was more than a 600-point turnaround. In the S&Ps, from peak to valley, fell about 80 points. It was really a big movement that came in there. Then, within a few hours, it was really right after the market closed, the president came out and really softened his rhetoric and said he would sign a standalone agreement where he would send the $1,200 over to everybody, and also would sign a deal with a $25 billion rescue plan for the airlines. It was interesting because that day, I put out a Twitter poll, and my point that I made on the Twitter poll was, if the airlines, bought something like $18 or $20 billion in their stock back and left themselves with no cash at all, and now they're in a crisis, it's bad due to their bad management, and really the taxpayers should not pay for their bailout. So if they wanted to get rescued and stay alive, they should essentially sell the stock that they have. Sell stock, doesn't matter the price, raise the money that you need, rather than putting it on the backs of the taxpayers. Well, that poll said 89% of the people agreed with what I said. Really interesting. But, of course, nobody hears that. Well, on Wednesday, by the close, the market had gained back most of its losses as the buyers came in being optimistic. Fed minutes that day said that they really want more fiscal stimulus, and that's because they're feeling impotent, that they can't do a lot more QE, they're not going to negative interest rates, so they really are pretty much begging the government to pass some kind of fiscal stimulus or a rescue program. But in their minutes, the Fed heads, they argued whether or not they should promise inflation over 2% or not. Well, they have not been able to get inflation over 2%, and basically they create deflation. And I've got something really interesting to show you about that in just a moment. On Thursday, we saw the markets move to the upside again, as the president said he would restart talks with the rescue program. And there was rumors coming all over the place. Pelosi's response was basically no standalone deal, and wants a comprehensive deal. And then for a little while, the market just froze. It just absolutely wouldn't move, waiting for some news. Or, of course, rumors of progress. And then we really did start to get the rumors. First rumor that came out on Thursday, well, the president wants a skinny deal. And then the second rumor was, well, the president wants a bigger deal. And then Friday brought, well, some pretty good upside action as the rescue plan seemed to be getting closer and the stocks did get a lift. They also got helped by the fact that AMD was reported by the Wall Street Journal to be in advanced merger talks to buy Xilinx, and that did help the tech stocks move to the upside. Then another rumor came out, as McConnell said, that it's very unlikely that there'd be any kind of a rescue deal before the election. And then the next big rumor came out, and it was accompanied by a tweet from President Trump that they were actually going to offer a $1.8 trillion deal. So that's stepping up pretty big. And the president's tweet said they're getting close, and we're going to go big. Well, of course, the market had another leg to the upside when that happened, and the market here is pretty strong on Friday and has some very, very good gains for the week. For now, well, the stock market looks like, in our opinion, it's really stuck in a range. And we're going to call that range, on for the intermediate basis before the election, like 3,200 on the downside, 3,600 on the upside. That's pretty wide. Short-term view coming up at the end of the show. We're going to narrow that down a bit for you as we look at the shorter-term charts coming up. And the market, of course, is now, I'm reading so many things that the market is strong on the prospects for a Biden win. Well, it wasn't too long ago where a Biden win seemed very scary for investors. And now they're talking about, well, if Biden wins, that's the end of the tariffs, and that will make a lot of corporations happy. And then, of course, if Biden wins and the Democrats have the both houses in Congress, well, then it's basically stimulus to infinity and beyond. So all of that, they're making a case, is bullish for a Biden win. And then, of course, there's a case that if President Trump wins, it's bullish. So everything is bullish, right? Well, I don't think so. There's so much that's coming up just in this next month. That's why I'm talking about this range that we're going to be in. And basically the strength is because investors really know that the fifth government COVID-19 rescue is coming, and it's coming in some form. And neither side wants to give the other one a win. And after this, it's really going to be much tougher to get anything done. We saw on Tuesday, as there was just a whiff that there would be no deal, and the stock market really fell very, very hard. And that's because the stock valuations we're seeing now are false. They're pumped. They're pumped by the Fed, pumped by the government, and the Fed wants more of this to go on. The government wants more of this to go on, and neither side wants to give the other one a win. At the other side, neither side wants to look like a villain, so they're probably going to make some kind of a deal that they can all say, well, we're in good shape now, we did the deal, we did what we needed to do. So something is probably coming, and the problem is that they keep doing the same thing, and it doesn't work. It doesn't bring strong growth. We have not seen strong growth for a decade, and it doesn't bring any inflation. No matter how much they promise they're going to get it over 2%, it doesn't bring it. And there's a reason for that. And I'm going to share a couple slides with you right now that I think are very important, very valuable, that you're going to get some sense of what's going on for quite a long period of time. And take a look at this as I switch over to these slides. So the first slide that I'm going to show you in here is a chart of the velocity of money. And this is so interesting because when you look here back in the 60s, 70s, you see these velocity of money. This is the comparison to the GDP was really pretty strong. And the velocity of money really gained ground up in here in the 90s, 95, you can see that. Now, what happened, when you look at the time frame of long-term capital, and then you look at the dot-bomb period starting in 2000, you look at the financial crisis. So here's where the dot-bomb period started, right over here. The great financial crisis right over here. All of this period of very low interest rates and Fed QE all through here. Operation Twist. More problems, and the massive plunge in the velocity of money. The Fed can't really stimulate anything while money is not moving through the economy. This is really the problem, but nobody wants to really face it. Well, why exactly does that happen? Well, I read a really interesting article, and I really wanted to share this with you so that you can see the collapse in money, in the velocity of money that they have created. Take a look here, and I'm sharing an article with you here. The source is the Reform Broker. This article by Joshua M. Brown. He's quoting Christopher Wood, who is CLSA Managing Director and Chief Strategist. And I took some clips out of here for you to see because I think these are really important. The best way to illustrate that quantitative easing is not working is the continuing decline in the velocity of money, resulting in a lack of the credit multiplier since the unorthodox money regime has been introduced. In America and Japan and the Eurozone, velocity has continued to decline. We didn't learn from Japan. That's my input in there. And that has happened since the financial crisis in 2008. It's really happened since the dot-bomb crisis in 2000. Thus, U.S., Japan, and the Eurozone money velocity measured as the nominal GDP to M2 ratio has declined. And you could see it's declined very sharply. Japan is actually a bigger decline than that. Money velocity is now at a 6-decade low. This is why those who have predicted a surge in inflation in recent years caused by the Fed printing of money have so far been proven wrong. For inflation, as defined by conventional economists like Bernanke in the narrow sense of consumer prices and the like, it will not pick up unless the turnover of money increases. So in other words, money has to move through the economy much faster than it has been in order to compensate for the problems that they create. Essentially, it's a money trap. That happens. QE is deflationary because it shrinks net interest margins for banks via depressing treasury bond yields. It also enriches the already wealthy via asset price inflation. But they don't raise the consumption in response. Well, that makes a lot of sense, and that's why we're having this huge income inequality. The rich are getting richer by what the Fed does, and those people that are in middle America or trying to advance themselves, well, they can't because there's no growth out there in the economy to help with that. And he says, because how much more shit can these people that are in the higher echelon essentially possibly buy? So the money doesn't go down where it's supposed to go. Finally, it leads to the preference of share buybacks versus investment spending because the payback from financial engineering is so much easier and more immediate. Well, wow, yes. What do you think about that? That is the issue that we see going on right now as the economy cannot get any real growth going. When we have these conditions going on, the Fed is essentially administering poison as a cure. I mean, it's just ridiculous. And it's amazing that all of these academics and the few that are really in the business world don't understand it. And they look at the numbers, but they don't make any change. So here you can see that huge decline in velocity that we have and the issue very, very clearly that we have an economy that's not going anywhere and a stock market that is based on, well, just funny money, printing money, unreal valuations, and risk that is certainly out there. So I kind of wanted to share that with you, and I think it's very, very significant and very astute when you look at that. And how are we going to get a pickup in the velocity of money? Well, by getting the government out of the way. This is really why the Fed and the government are in a lose-lose situation. They're wrong if they do more, and clearly you can see that, and they're wrong if they do less because they're under political pressure and the economy will turn down. Well, it's going to turn down no matter what, and that's why we say to you that the economy and the stock market have very, very big problems ahead. Stock major indexes for the market this week. We have very, very clearly the market very strong in anticipation of this new deal that's coming out in the hope that that will stimulate the buyers to come back in. We have the major indexes up 3 to 4%, Dow a little bit weaker than the NASDAQ and the S&P 500. For the second week in a row, we have the Russell Russell having another big up week, the big leader for the week, up about 6.5% on the week on top of last week's big gains. The 30-year bonds moved down 1.5 points. This is very much in alignment with what we were looking for, as we see the 10-year yields pop 8 basis points to 77 basis points. Our target for the short term has been 80 to 86 basis points, and we think that there's still some hits coming for the bond market in the next couple weeks. I'll show you more about that. Gold market up big on Friday. It had a bad day on Tuesday when the president called off negotiations. It fell very, very hard. And another big thing that's going on is a weak dollar, based on the fact that while the Chinese yuan had the biggest increase day in 15 years, the really strong yuan is very significant, and the weak dollar is very significant. We think the dollar is going to get much weaker, and we've talked about that. That, of course, is good for the gold market. So gold up about $24 on the week, silver up about $1. So they were really strong. Dollar down about 0.8% on the week, and we think that's just the start. And oil market, well, Hurricane Delta headed up to the Gulf Coast. Man, did they get hit up there. I'm in Florida, and we've been lucky. These have been skirting by us. And the Gulf Coast refiners, they have the most number of refiners shut down in 15 years right now, as they have really been getting whacked. For that reason, oil market up about $4 on the week. And that also was in alignment with what we were looking for the week. So that's it for the opening. But one more peek at this. You really get this, the velocity of money and how that's collapsing, and really a great explanation for why that's happening. Please do go to the askSlim website. Explore that. Take a look around there. We have so much. You won't believe how many things we have coming to help you raise your probability of success. If you're watching this on YouTube, or go to YouTube because we put lots of stuff out there, subscribe to that channel and click the notification bell so that you get notified when we put stuff out there. There's some things we put out there that are kind of repurposed out of some of our shows. Some things are specials that we put out there. So I think it's really great if you become a subscriber to the channel. Make sure you give us a thumbs up if you like what we put out there. You don't like it, you give us a thumbs down, well, make sure you put something up there that can help us. We always want to be better. We look for very, very good comments in either direction from the people that come there. And follow us on Twitter at askSlim. We're always putting something up there of interest. And if you want information about our memberships, you can write to Matt at askSlim.com. In a little bit, I'm going to show you we're in the wrap-up stage of the fantastic special that we've been offering for level 2 membership, and I will show you that in just a couple of minutes. So that is it for the opening, and here we go. We're going to look at our short-term view of 5 major markets. So we do this every single week. We try to get a good sense for the short term being, the next 2 to 3 weeks is what we're looking at. And we rate ourselves by the patterns that we see. How close was the pattern that we're looking for over, 2 or 3 weeks? How good were the resistance and support zones? And the cyclical patterns, are they really accurate? Price levels, are they accurate? So we rate ourselves by 3 or 4 different things, and then we come up with a percentage of how we did. This week was really nice. We've been running, other than 1 week in the last month, which was 55%, we've been running in that 80 to 90% category, which has been fantastic. Our weakest area this week was the stock market, which we thought it would be choppy. It would go down early and then rally back up into these resistance zones. Well, it never had to dip. So we essentially only get partial credit for that. The bond market was weaker, so we get partial credit for that. But we really nailed oil and the gold market and the dollar. So we get about 80% on the week again, and a very, very strong week. So now let's jump into the light crude market and take a look here at the short-term view for light crude. So we're looking at a daily chart, and what we have on the bottom, for those people that are new, are cycle brackets. This is a drawing tool. Depending on, this is Thinkorswim from TD Ameritrade. Now Thinkorswim TD Ameritrade. They're our preferred broker, and if you go to our website and you can see in the upper carousel, if you want to become a TD Ameritrade account holder, you do it right through our page there, and you just click on it, and you'll be able to do it, and we get credit for that. So please do become a TD account holder. Then you get our charts, our level 4 charts, which you can have just a tremendous amount of value as far as all of the work we do. We do cycle analysis on about close to 400 different symbols that we look at, and our focus list is on the 84 best traded ones. Light crude is one of them, 24 different futures, 12 different ETFs, and 48 of the top traded stocks that we do daily and weekly analysis on all of the time. So please do open up a TD Ameritrade account. So here you see this cycle bracket on this TD Ameritrade Thinkorswim chart, and a lot of the other platforms have this. TradingView's got a couple of nice versions of this, and they offer a nice charting program too. So this is the cycle, how it resolved itself, and you can see how close that was right there. And we thought that there'd be a rally right in this period, and we really got that. So it worked out really nicely. So for the next really 2 weeks, what we're looking for is some continued upside movement. We think we're going to break out past that resistance. That would be bullish if we do that. That's over 41.65, and then some modest correction in here. Momentum has improved a bit, but you can see it's choppy, and the slim ribbon is very, very choppy in here. And I want you to, I'm giving you a heads up. We have a new indicator coming out that combines some of my favorite indicators, the slim ribbon being one of them, to give you just amazing signals. So I want you to watch for that. Light crude, we're going to expect it to get up through here and then pull back. Don't have an anchor point in here, but we're going to get probably a buyout over here. Some of the evidence really with the neutral momentum and this choppiness that you see right over here is that, well, it's improving. The intermediate pattern has bottomed and has turned up, but the intermediate pattern still has got some negative momentum in there. I really think that the next 4 to 6 weeks are going to be pretty good for the oil market, and the longer term really looks like 44, 45 on the upside to us in the light crude market. Next thing we're going to look at is the gold market. This is /GC. Remember, if you trade the ETF and not the futures, you can look at GLD to trade. Now, this again, cycle analysis. There's a lot on this chart. Now, some people say to me, I have some of the messiest charts they've ever seen. Well, I can deal with that. But you can see there's tremendous value that I see in here. This is the cycle that we're following right in here. You can see that. And you can see how it resolves itself, just following that cyclical pattern perfectly. Our sense was that it was going to hit that minor resistance, and we were hoping that it would be able to get that support and then turn upwards, and that's what it did. We were afraid if it was going to get below this level here that it would break down, but the weaker dollar, the stronger Chinese yuan really helped that, and it moved up very sharply, as we can see in there. So the gold market did pretty much as we anticipated. We thought it would be moving up to 1934 to 1940, and look at that. It got in that almost perfectly. That was really a bullseye. And that's the second bullseye we've actually had in the last 2 weeks. So what are we looking for now? Well, we're looking for it to maybe make a little more upside ground than here, but then you see a correction that is likely coming in here over the next week. So for the next 2 weeks, it looks like a little bit down, maybe into mid-late week next week. This being a buy zone in our opinion, and that price right over there is around 1905. If it could pull back to that level, down to here about 1894. Beautiful spots right there it would be for the next rise in here. And this is opposite of what we expect in the dollar, of course, which we expect to be moving to the downside. Some of the evidence, intermediate pattern still pointing to the upside. Intermediate momentum pointing to the downside. We have a conflict there. We have a short-term momentum right in here as negative. but it's beginning to turn up in here. So we'll see if it can turn neutral at that time. And what we're looking for is some modest upside still, unless the dollar gets much weaker, and then the upside will be pretty significant. 3 weeks, you can see the decline, and then this move to 1967 or higher, depending on, again, the weakness in the dollar. So that is the look at gold. Now we're going to take a look here at the dollar. So this is the dollar sign DXY. A good way to trade this is to trade the euro currency, or FXE, which is inversely correlated by about 57%. And you could see what we're looking for in here was that it would be moving down. We thought it would chop around a little bit and then get hit. It chopped around a little bit and then got hit. Moved down into that support area very nicely. So what are we looking for now? What have you done for me lately, right? Well, we're looking for a few more days to the downside. Our targets right over here, as you could see, are right at the bottom of that support. That's about 92.88 or so right there. This target right over here is around 92.35, 92.40. We expect that to come in the next few days. The reason that this is running past the ideal cycle low here is because there was a minor shift in here. This ran about 5 days late. And I'm wondering whether this is now shifting out a little bit. So that's why we're saying a few days down in here and then getting a bounce. And this bounce in here, once we have our anchor point, is going to be another sell zone. You see the sell zone right over here? Whack. You see the sell zone here? Well, it couldn't even really get up there. It failed in the lower resistance. The dollar is weak and in trouble, and the de-dollarization that's going on in the world, I think it's really going to continue and really accelerate. And we expect to see a much, much weaker dollar. So this time period that we see as the sum of the evidence, these next few weeks, well, intermediate, there's a little upside phase going on, and that upside phase really was from here to here, and now that is ending, as you see in here. What we expect to see is big downside risk that goes out into late October. When I look at this cycle right out over here, this points to a low in November. So I'm wondering whether or not it's going to even expand out a little further when I look at that. So really a lot of weakness that we see in here. And the dollar, which had somewhat strong momentum, changing right in here, as you could see, long period of momentum negative brought you that big decline. The PO projection oscillator giving the sell signals, and in here it actually gave a little buy signal right over here, and it got weak again and then lost that upside momentum. So it's neutral right now. I think you're going to see negative momentum in here come back pretty quickly. A weak dollar, and we're going to look for prices to decline down to those supports, 92.88, 92.40, 45, 92.40, 35, something like that. So those little pennies don't make a big difference. As you could see, the direction really looks down for the dollar. Next thing that we will show you right now is /ZB. This is the 30-year bond, as you can see right in here. I'm going to grab it and make it a little bit tighter in here so you can get a little bigger picture of that. And you can see that, again, I really like to show this for our first-time viewers. This is called a cyclical harmonic family. So each of these big dominants that you see right over here, this is made up of 3 cycles. And you can see how the minor thirds, just like music, minor thirds, are coming right in here, and how you can see this minor third and this minor third and this rally in the final minor third, which normally brings a big decline, that's where you are right now. So you have the likelihood that we're going to see higher interest rates, and we were calling for the bond market and all of our bigger picture analysis for weeks and weeks and weeks to head down to the 71 level or lower for the 30-year bonds. So this level right over here you can see is about 71.30. This level right over here is at about 69.10. Those are really our downside objectives for the bond market. as, just call it roughly 72, so 169.5, 172, 169.5. The traders in the, of course, I'm an old bond trader from the pit. I stood in the 10-year and the 30-year for a while. And we don't really use the 100 in there as our handle. So it's 71, 72, 70. And that's where we think it's going, down in that direction over these next few weeks. Some of the evidence very, very clear that multiple time frames point to the downside. And late October, early November low in this range that we're talking about. Very weak bond market, increase in yields, all acting very much as we expected. So that is a look at the first 4 of the 5 short-term charts that we look at. Now we're going to get into the S&P 500 in 1 second. But before we do, I want to remind you that we're in our final week of our Level 2 trial membership. Our stock index report, which is just a daily deep analysis on the indexes. Our stock index report live stream, which is so amazing. It's incredible. 15-minute charts for very short-term day traders, S&P 500, NASDAQ, and the Russell. Support, resistance, acceleration zones to catch the big trade. Our reversal scout to help you know what direction to be on, and it really helps you with which are the stronger and which are the weaker index. The weekly stock index report for swing traders, position traders, investors, our weekly ETF review, the Slimulator Momentum Tracker with our algorithms built in, 3 different time frames, some of the evidence output for our overall directional bias for position traders, for investors, all of that included in this, plus my library, over 500 videos, 9 different categories, all of that $22.50 for the first month. How can you not do it? If you're not a member, haven't been a member, really, really try it. You can also get a quarterly trial discount. Also write Matt at askSlim.com for info and a link. What about all of those videos that you get in that library? Well, if you want to learn about trading or you want to really boost your skills, FutureSpeak helps you a lot. Every Wednesday, cycle analysis of 24 different futures contracts with the indexes in there. Our tools for tax, more than 80 videos on how to use different things in your charting platform. I really explained very clearly how to use so many very, very great tools, studies. Trader psychology, you have personal issues that reduce your profitability. Well, I'm great at helping with that. 24 years as a certified facilitator in personal growth work, certified in emotional intelligence, IRA-MO, longer-term strategies for IRAs, and more. We don't do a lot in there. I'll be doing some more in there soon. Stock sectors, we do this all of the time, and now RV is really starting to really pop. Do some fantastic stock sectors thing in there. And I just did a new one this week, which you're absolutely going to love, where I show the very, very strong solar stocks, the very weak bank stocks, which are giving warnings, and also 6 stocks that I think are buys in the coming election drop. Big picture analysis, I took a really kind of a monthly look in big pictures at all of the major markets. Style, strategy, and plan, just lots of subjects about how you engage in the market as a trader. And of course, Market Week and Short-Term View. You get to look at the archive that we have in there of past shows. You learn a ton. And then we do askSlim Live. About every couple of weeks, we do a great, about a 70-minute live program with Q&A from the members, and we do some analysis, demonstrations on stuff. So fantastic. And you get all of those replays, and you will also learn a ton. All of that, imagine all of these things I talked about. This ends on October 16th. So write to Matt at askSlim.com, M-A-T-T at askSlim.com for info and the links for those special trials. Remember, you only have another week where you can get this, and then we're probably going to not have this for probably another 6 months or so. So this is really the time. A great way to really try out all that we have. $22.50 for the first month. Come on. I mean, you spend more than that in a week on your coffee, don't you? All right, please do subscribe, and of course that helps us and it helps you, and all we want you to do is get better, because your success is our success. All right, Here it is, the short-term view for the U.S. stock market. We're going to look at the S&P 500. Like I said earlier, we only get partial credit for this. We thought it would be choppy and makes some higher ground after a decline. We thought it would test 3,300 on the S&P 500. It did not do that. It went straight up into the resistance zone that we thought would happen after a dip, or could happen. Now it's actually stronger. We did not expect that it would move up. We expected to see a wide range in the market between now and the next few weeks. We thought it would be, the range would be 34.65 on the upside, 32.47 on the downside. Well, what happened was that it moved up to the top of the range and then began to, continue to move. So here we are now at 34.74. So now we're about 7 points, not that much above the levels that we thought we would get at. We upgraded the structure in here again. Now this is the second time as we got through resistances. That's really what happens. It's a mechanical thing that we do that really gives us a sense. Once it gets through into the upper channel, as you can see here, it's a far more positive occurrence. And then the momentum turns negative over here. Positive, and it really, does enhance our understanding of what's going on. So we have raised what we think is going to be the bigger range, but not quite the range that we talked about in the beginning of the show. So the upward target now, or the resistance at the top of this here, is at about 35.07. That's a little higher by about 40 points from where we had it last week. And what we think is that it could still make a little bit more ground, but then we get into this right over here where the minor cycle, which bottomed really in a strong way right over here, and the dominant cycle begin to point to the downside. So what we're looking for in the next couple of weeks is maybe a little more upside attempt in here. It really depends. I think that if a stimulus program is passed, and it's anticipated that it will be very quickly now, then you'll pop into this area quickly and then begin to give it up. So we're going to look for a decline. Now, if it makes higher ground, these numbers are going to go up by a little bit. But we think that there is a lot of risk coming into the market starting in just a couple of days. So we're going to look for a downturn sometime in the next couple of days after maybe testing that level up there and then coming down. Now, because we're in the top of the channel, we think we'll probably stay in the top of the channel during this period right over here. That would give us a test on the downside coming in the area of the 33.80 that I have right there, and maybe 33.45 to 33.15, depending on how much selling becomes in here. 33.15 is 160 points to the downside. That would be pretty significant, and still we do believe it could happen. But right now we're going to look for 33.80 is the most likely occurrence in the next week and a half. So this comes out to October 22nd. So between the 20th and 24th, really based on the principle of variance, is where we see this decline coming to. We have those dates also aligned in the NASDAQ and in the Russell. Now, the Russell is much stronger than this. The NASDAQ is much weaker than this, as the NASDAQ stocks really have some significant breakdowns in there. And that's why I believe that this upside is limited, because I think you're going to start to see some big hits on the downside in some of those tech stocks that have led the market and now are lagging this upside move. The NASDAQ is not anywhere as strong as what we're looking at here, and the Russell much stronger, as the Russell has already taken out the high that came right in the market in this time frame. So Russell much stronger, the NASDAQ much weaker, and the S&P 500 kind of in the middle of that. The range that we're looking for in our sum of the evidence is that we're going to see over between the period between now and the election a little bit wider range. So an area of 35.07 is what we're looking for on the upside, and then the bottom that comes in around this 33.15 area right over there is kind of the range that we think we're going to get into. Is we get a break in here, and then we get into another rally phase over here, which takes you out towards the election time, and then the risks, of course, really pick up. If by some chance it gets really weak and gets below this level right over here, 32.10 or so, that changes everything in a very, very significantly negative way. If it gets above this level over here, 35.07, then the 35.88 level would be the next level. We make the probability of that less than, I would say less than 20%, the probability of getting below this 33.15, more like about 60%, and then probably stuck somewhere in the middle. So you see we're giving it about a 3-to-1 risk reward to a downside break versus an upside breakout. And that's about everything that I could give you in here. Targets in here for the next week and a half, getting down below that 33.80 number next week or into the following week, October 20th to 24th, the target timing for a decline and that next bottom. That is a look at the S&P 500. And that's everything we have to bring you today. I hope you found the show incredibly interesting. If you're watching right now just at the clip of the S&P 500, go back and watch the beginning of the show because there is some very interesting things in there about money velocity. So I hope that was really incredibly interesting to you, and I'm looking for your commentary on that. That's it. I want you to be so incredibly careful. It is so crazy out there, and I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been